So hello everyone, I'm 𝗿𝗵𝗶𝘀, Chief Market Analyst for TO Markets, and today we are going to study something that is very effective. It's about ABC or ABCD formations, and I'm going to soon explain you the difference. But first of all, you are most welcome, and I really hope that you guys take this opportunity to learn. So if you have any questions, feel free to ask. And even if you see this video afterwards and then you want to ask questions, you can always email us at support@𝗿𝗵𝗂𝘃.com. So let's see. Here we go. I want to very quickly mention you that if you haven't got a TO Markets account yet, it's a great trading environment. So go and check this out. Go to 𝗿𝗵𝗂𝘃.com/contact and find more about this. It's a really good trading environment because wide spreads are the number one killer in. If you have a good trading strategy that is fairly active, you want to have a trading environment where the execution works, there's no delays, and you get real tight spreads and good liquidity as well. So in today's webinar, we are going to talk about ABC and ABCD patterns, and even though these are very simple patterns, people have some confusion about how to actually spot them, how to use them. And in this workshop, we're going to discuss the definitions, obviously, but also I'm going to give you some tricks and filters, something useful that you can take away and study here. And I'm going to talk about market entry techniques and how to set targets. Risk management is one big topic that we're not going to touch too much today. Obviously, I would assume that anybody who wants to trade the markets without actually getting wiped out every now and then will use protective stops and doesn't take too big of a risk per trade. But that's something I'm assuming. Obviously, I'm gonna remind you guys every now and then, use the stops, but I'm assuming this is what you guys want to do anyway, so I'm not spending too much time on this now. Please remember that we do not offer any investment advice, and you should attend this webinar or watch this video only if you agree with this disclaimer. Take a screenshot or pause the video and read it through, and only stay on if you agree with the fact that we don't provide any investment advice, and this is only for marketing and educational purposes. My background, very briefly, I have been in the institutional side and retail side, so I've I started in 1998, so I've seen quite a bit of different market swings and different crises taking place. So over those years, I've picked up quite a few things, and I know that I can help you if you want to work with me. All right, so let's move on. Basically, in order to trade, you obviously need the account, and I'm very briefly, I'm going to spend 1 minute on this, but I'm going to show you how to get started with trading. So obviously the first thing to do is to go to 𝗿𝗵𝗂𝘃.com and register. And when you do that, you will get an email with your wallet ID. So go follow the link in the email, and then you can get to your client portal. And over here you have two very important sections. Obviously there's quite a bit of important stuff, but you need to be able to deposit, so you find it there, and you have the deposit options here. And then the download center is another vital section for you, because then you can download our trading platform here and start using it. So once you do that, you basically get another email where you get the credentials for the demo account, and then just type them in or copy them in and start learning how to use the platform. And this is the last slide on this. if you go to account settings, if you choose an account here in the list, and you go to account settings, and this is where you can reset the password if you ever forget it. So that's easy and handy. Okay, let's talk about the sort of basics first. And if you have any problems, like I'm seeing a comment here that I can't see that image. It seems that everybody else is able to see it, so I don't know how much I can help you with it, because it's most likely to something to do with your settings there. However, you will get an email afterwards with the link to this video, so you don't have to worry about it. Just listen, and you can watch the video later. So that's my question for you. It might be kind of basic question, but I just want to focus on the very basics first. What moves the markets up or down? Can you give me an answer? While you type your answers in, let's look at Euro USD. It's just lately, and basically it has been moving higher. So what has been the moving force behind this move? What's actually making the market go higher? Yeah, Carlo, it's the demand. It's the news. Yeah, but the news on its own doesn't make the market to move. I could give you an example. Let's say that, okay, I'm going to bring up the charts now. I wasn't planning to do it yet, but I want to show you this. So let's go to just a moment. I'm bringing up these charts here, and okay, there we go. And Euro USD. Sorry guys, takes just a moment. I'll be with you very soon. And I'm going to take off some drawings here. So, okay, just cluttering the space. Okay, here we have Euro USD. And sometimes what happens with the markets, and I'm not saying this has happened with the euro right now, but I'm saying this because Carlo was referring to the news. Sometimes you get the market moves, and then you get a news event, like somewhere up here. And oops, let's take that again. And then the market, it's bullish news event, but still the market moves lower. So can somebody tell me what might be the reason for these occasions? What might be the reason? Why does the market sometimes move higher, then there's bullish news, and the price actually does the opposite? Any idea? Okay, I tell you why. That's basically because the traders were discounting the future events. They were actually pricing in that event that took place here. So sometimes you see a very bullish news event and the price moves lower because that news event was already in the price. So we get back to, yeah, the supply. And why is there supply? Because the big money traders actually see this happening. They know that they are bidding the price higher because they believe in that news event. They believe that the whatever fact that they are waiting for is actually going to happen. And this is one of those events where you buy the rumor and you sell the news. So it's always about the price action. It's always about supply and demand. The big guys create supply here because they want to exit from the positions that they bought down here on the way up. So we shouldn't blindly rush in to buy the market because there's bullish news. Okay, so that's something very important to keep in mind. So it is really the supply and demand. But the next question here, and you can always answer if you have any ideas on this front, what makes a price move sustainable? Why is a price move sustainable? And this links very closely to what we just discussed about this situation with euro. So who can tell me what makes a price move sustainable? Any ideas? Anyone? Okay, volume, yes. Volume you need, but basically volume could be selling volume or buying volume. So that on its own doesn't actually help. It needs to be further defined. And this is something that I hope that we will get to answer in today's webinar. By the way, I just remembered, I want to show you this. This is pound, and if we take a look at the hourly time frame, that's the market moved higher really nicely yesterday, and it was up here that everybody was excited about. Everybody was so excited about the Bank of England actually going to move with the interest rates soon. They have indicated that they are going to increase the rates as a reaction to inflation. But what happened? The price started moving lower. So that could be an example of market coming to a level where it's so overvalued already. The potential news event is so much priced in that the market reacts to the other direction. So what makes price moves sustainable is this. This is known as an ABC formation. We can also call this a one component in a trend. So now this is obviously a bullish ABC formation here, and I'm going to talk about this a little more in this webinar, basically because it's one of the most powerful, one of the most simple, and one of the most reliable indications of where the market is moving to. And if you have an idea why this is the case, please write your opinion in the chat. But while you do that, I'm going to move on. So I want to take a look at some examples, and you can always ask questions. You can always give your opinions in the chat if you like. But let me bring up the charts, and then we're going to move on to discussing this pattern in more detail. So this is Euro USD in 2-hour time frame. And basically what makes a price move sustainable is a series of higher lows. And this is what we try to catch with the ABC formation. We want to be able to recognize momentum first. This bit here is the momentum. So you have a directional move, and then you have a retracement, then you have a higher low, and the price starts to move higher. But everything starts with a momentum move. The price is moving from A to B, and you know that the market is gaining some traction. But it happened here, and the price came down, So this momentum move higher on its own isn't what we are after, what we look for. But basically we need to get the other components too. And the most important component to this is the point C. So we get some movement lower, we get renewed buying there, and then the market starts to move higher, right? So this is basically what I have here on the slide, just in case you want to take a screenshot or for your own notes so that you can start looking for this. Something I want to remind you guys, and when you're looking at the charts, it's kind of easy to see these afterwards, but the real skill that you need to build is finding these while the price is moving, while there is different markets doing different things, and you get excited about news, you get excited about your trades. But if you can learn how to identify these in real time when the prices are moving for real, then this is a very, very valuable tool. And I'm going to give you some ideas on why this, on how to do this, how to spot those opportunities. And by the way, there was a client who sent me an email asking about his trading approach. And this chart he sent me, I think there was 4 or 5 different oscillators. And I promised him that I will answer his question in this webinar without revealing his approach. And actually, this whole webinar is part of the answer. I'm sure you all have seen these charts where there is so many indicators that interpreting those indicators is going to be really difficult. It takes a lot of effort to understand what's going on. And I'm going to give you a solution that is so simple that it takes a lot of headache from you. And that solution is the ABC formation or ABCD formation. And after this webinar, I'm sure you understand what I'm talking about. So this is the ABC pattern and then the ABCD pattern. This is why we have the initial move higher, we have the retracement, then we have the break above the level B, and then there comes a point D where the market starts to retrace lower. So this is basically the definition side. They are very useful patterns. Why? I mean, if you want to build a trading strategy around something, if there is an indicator or any strategy idea, you need to have something that appears several times per day or per week, depending on your time frames, what you want to trade, whether you're trading 30-minute charts or daily charts. It's just obviously you understand that the lower the time frame, the more you have signals, but they are not that good. But if you go to higher time frames, you get less signals, but they are more reliable. That's one important point. Another important point is that this is not market dependent. You can trade gold, you can trade Euro USD, you can trade Dow Jones Industrials Average, DJIA, or whatever market. And you can always find this pattern or these patterns. So that's great, because you're not tied to something that takes place once every quarter or so. This is something that happens several times per day or week, and it's not market dependent and it's not time frame dependent either. So you can use, like I said, 30-minute charts, 15-minute charts. You can use 4-hour charts, or whichever time frame, daily or weekly, is your preference. You can apply the same principle in these time frames. All right. So, any questions so far? Obviously, I know it takes a little time for you guys to type your questions or comments or opinions, So keep typing and I'll come back to those questions once they come in. And I'm going to go to spend some time with the charts. I'm going to give you some useful tricks and filters on how to benefit of these formations. So, first of all, yeah, Albert, it's true. It looks a lot like a wave pattern. It is basically. I find that my approach to markets is I try to find something that is so simple that even simple person like me can understand it. Then it means that it's something solid, something that can't be argued about. Obviously, it's a good point to remind that no strategy idea is perfect. Markets have lots of randomness, and you just can't take one idea and expect that to get repeated every now and like every time, or 70-80% of the time, and the pattern is always reliable. That's not the way the markets work. Because if you have something that works, say 70-80% of time, the markets will see that. They will understand it. The market participants will start to buy earlier or later or fade the whole idea, and then the phenomenon disappears. So we need to have something that is so simple that it cannot disappear. But it also has to be so imperfect that you can still take advantage of it. And the idea isn't that you trade 100 trades and 90 trades are profitable. The idea is that you trade 100 trades and maybe 45-60% in that range are profitable. And the rest, the losing trades, are taken care by your risk management techniques. So always trade with stops, right? Okay, so when you look at the price action, it's sometimes difficult to see where those patterns actually exist, where they are. Here's one occasion. This I think is quite clear, because let me take that tool here. Here's the point A. Here's our directional move, and then we get a move against it, and then the buyers step in again, and the price starts to move higher. So let me move this out the way. Now we have the point A, we have the point B, and we have the point C. Now, it is a little easier when we're looking at historical prices, and like I said, it's going to be a little more challenging when you're doing this with the live prices. But just to make this to look a little bit like a live situation, I'm using this tool here that allows us to go back to when the price was here. Excuse me. So obviously we don't know the point B before the price has started to move lower. Let's make this a little bigger. So there's the point B, but the price needs to move lower in order for us to decide that yes, we do have the point B now in. Then we can say that okay, this is the breakout level, this is the level that market has to break in order to actually start moving higher. And the same applies down here. The market has to start moving higher in order for you to realize that yes, we probably have the point B actually point C actually in place. Does it make sense? Can you guys follow what I'm saying? It's not very complicated, but I just want to make sure that anybody isn't confused about this. So when the market moves higher, we still don't know if the market's gonna go beyond the point B. But when we have the market moving higher from the probable point C, I should say, then we can say that the market it's likely to move higher. It probably has put in a higher low. And maybe this is somebody might want to consider buying the market here and then keep on adding to the position and see if it breaks the point B. But some other people actually like to buy the breakout. And this is something you have to decide. There is no right or wrong answer to this. You just have to decide what is your approach. And then on the downside, now that we have now that the market has broken above the point B, we have further confirmation that yes, this is actually the point C, and now the market is trading above a potential support level. But the downside with the breakout trades is that placing the stop below the point C will actually mean that now the distance here is bigger. So you can have, if you want to keep your risk equal on every trade, say that you're only risking 2% per trade, then it obviously means that up here you can have a smaller position. But if you were looking to buy down here, the downside is that you don't have the confirmation yet. You don't know if the price is going to move above the point B, or whether it just rolls over and goes below the point C and continues this weak move. Yeah. 𝗿𝗲𝘁𝗄𝗏 soon is asking, how far is the expectations for D? That's a really good question. A really, really good question, because I'm actually going to come to that soon. But let's do this first. So wherever you buy, there are sort of pros and cons. The higher the price is, then the more time you allow, the more confirmation you have that yes, your sort of interpretation of the market was correct. But the price you pay for that further confirmation is a higher price. It's the fact that you have to take either a bigger stop loss in terms of percentages relative to your account size. Say that, okay, there's two options. When you are buying at a level, you can either decide that your risk varies or that your risk is constant. If your risk stays constant, then your position size has to vary. It has to change accordingly. But if you want to keep your trade size, your market exposure, or say at 1 contract or 2 contracts or 10 contracts, whatever is your size, then obviously you need to accept variation in your risk. So if you want more confirmation and the market is trading up here, then you are paying for that confirmation in terms of higher risk or lower participation rate in the market. If you're buying down here, and let's say that your stop level goes I'm not saying this is the right level to place your stop, I'm just using this as an example, but if the stop is down here, then your buy level is closer to that stop and you can have a bigger position size. Oh yeah, 𝗿𝗲𝘁 soon is asking if an uptrend, downtrend concept is applicable. Oh yes, definitely. You have very, very good questions, my friend. Excellent questions, actually. I have planned to cover both of your points. So let's see how this goes. What the market does. It moves higher, comes back a little, comes back a little more. Ooh, it came all the way down to this point, almost to the point C. So it's actually a very good, I didn't remember the price is going to move like this, but this is a good reminder that if you are buying a breakout, you have to consider this. The price might move actually almost to the point C before it starts to move higher. If you buy here, it's a little bit easier for you, but then you don't know if the market is going to break. See, there's no easy way out. Trading is challenging. You just have to find a strategy that works. And by saying a strategy, I'm not meaning an indicator or a formation. With a strategy, I'm referring to a full trading strategy that has all the considerations in. It has the entry rules. It has exit rules for losing positions. It has exit rules for winning positions. It has rules for trade management, whether you keep your position, full position until your target, or whether you just take partial profits along the way. All these considerations has to go in order for you to have a fully fledged trading strategy. Okay, but then there was this question, what's the expectation for D? And I want to touch upon that. Actually, let's do it now. So I'm going to take these arrows out the way. There's a tool called Fibonacci extension tool. And it works like this. It's actually ideal for target setting in this formation. You move from the point A to the point B, and then you move the tool to point C. And it gives you various levels for your targets. With the, let's see if we have more levels there. Yep. So the nearest 1.23 is that most likely target that is going to get hit. And then you have the other targets. Let's see how far this market actually goes, whether it hits the 2.4. This was, now we are in August this year. The market is just going sideways, going nowhere. Is it actually going to hit our target? No. It starts to move to the downside. So, target setting is one of the most challenging issues in trading. It's relatively easy to find these entry opportunities, but then finding the correct level to exit the price move or the trade when the price has actually moved. What's the correct level? You're never actually going to get the correct level. And trading isn't about what happens with this trade. Trading is about what happens with the next 10,000 trades. Is your process for entries and exits so good that you can actually take the next 10,000 trades and expect to make money over that number of trades? There'll be some losers, there'll be some winners, there'll be some small losers, and there'll be some big winners if you trade correctly. And you might have noticed that what was missing from that list was the big losers. So if you have small losers and small winners and big winners, then you are doing something right. If that's how your trades look like, then you are doing a lot of things right actually. So yeah, so this is a tool that you can use, and this is available in MT4 also. I'm using TradingView here because it's a better tool for presentations in webinars. But here you can choose different levels. Basically, I can't tell you what levels are the best. There is no such thing as something being the best. Like there is no best car or best house. Everybody has their preferences. but you have to find something that works for you. So if you find that the market most of the time moves to 0.5, you just take your money there and leave the market to run up or down, whatever it does. It's not your business anymore. You have exited at 1.5. And if you know that most of the time after ABC and a break, then if the most of the time that 1.5 is met, then you have a very good basis for your trading strategy. Okay, so what about those formations, ABCD formations? What's the point with them? Let me actually take you there. I had an example. I just want to. Okay. Here we go. ABCD is basically the ABC formation, but with the target point D. So we have covered at the point D. Some people say that this is a bearish formation. I would disagree. It's basically ABC is bullish and they say that ABCD is bearish. I don't believe that, because like you can see here, the market moves higher, moves lower, moves higher, moves lower. That's a trend. I mean, to create a bearish formation, then you need to have something like this. The market moves higher, retraces, moves higher, retraces, moves higher, retraces, creates a lower high, and then breaks this point here. Oops. This point is the point that reverses the market. And if you then get lower highs and lower lows, then you have a downtrend. But ABCD is more of just a formation where you have a trend in place and your target is met. So that's just to clarify the difference here. Now I promised to give you some tips on, and actually how to, let me get rid of these levels here. There's too many, some old drawings. So I promised to give you tips on how to find these formations. And one of the easiest ways, because sometimes it's a little difficult to read the candles, one of the very powerful, easy tricks is to go to a line chart. Oh yeah, Carlo, that's Dow theory. You're right. It's exactly about that's it. Yeah, and after 20-something years in the markets, I firmly believe that the simple things work the best. The simple things work the best, and here I'm taking you to the simplicity. By the way, let me know if this far what I'm saying makes sense to you. Just simple yes will be enough. Does this make sense? Does this make sense, friends? Where are you? Am I alone? Don't leave me. Hey, guys, I need... good. Albert's with me. Lovely. Thank you, Albert. Okay. So, basically, if you go to a line chart, a line on close chart, you can very clearly see where you have a potential point A, and then a potential point B, and then a point C. And once you have those, let me widen this a bit. Once you have those, you can start thinking about the point D. Here's the point B, and we have the points A and C. Now we can go and move back to the candle chart. Oops, not the hollow candles, but the actual candles. And now we can use the Fibonacci extension tool, moving up from the low to the highest high, and then actually here's the point C, but because that we didn't see the spike earlier, that becomes the point C now. And as you can see, the 1.23 was a target level for somebody. The market struggled to get above it. Then we moved to 1.5 and 1.6. We moved also to 2.41. And the market, let's see if it actually moved also to 3.61. So with this approach, you can see more bigger moves. You can catch the bigger moves. And then the question is obviously for you as a trader, where do you exit? Do you take some of the profits here at 1.23, a little bit more at somewhere around these levels? Maybe you want to take half your position off there and then the rest up there. Or the other option, that there's always the option of following the price action and trying to figure out when the trend reverses and only then exit. And then if you are an experienced trader, that might actually work for you too. Yeah, Carlo, line graph makes a lot of sense. Sometimes it's a little difficult to read the chart with the candle, the wicks and everything. But when you have the line chart, it very clearly shows you the trend. Market is making higher highs and higher lows. And actually, people sometimes talk about these ABC formations as if they were something that are very isolated occasions, and it would be something different to trend. I'm saying it's just a component in a trend, and you can see this repeated all the time. So if you go and let me take the lines off. Also, we can say that there is, if you go here, you have a point A. When do you know this? When the market has started to move higher, then you know that there is a point A. Then the potential point B is there, and you know that when the market has started to move lower. Then the point C is it there? First you think it's there, the market starts to move higher, then this low is actually slightly lower, so there's the point C. And that you can know, this point C you can know somewhere here, that probably now the market has put in a higher low. So this is something that repeats all the time. It is, as long as you have an uptrend, you have ABCs, and eventually also a ABCD, depending on where you want to place your D. So, and also, 𝗿𝗏𝘁𝗄 soon, you asked about the trend idea here. If the market is trending higher or lower, yes, it very much plays into this idea. Because if you go to a down market or a downtrend concept, you have the same concept working there. And it happens in different time frames, in different all the traders, I'm sure, most of the traders are looking different spots where to place their A's and B's and C's. But here we have a potential point A. We know it's somewhere here. Then there's a potential point B, and we know that when the market has started to rally higher. Then the point C, we know this when the market has started to move lower. Then we can again use the Fibonacci extension tool. Actually, I'm just going to simplify this and use the line on closed charts only. And oops, let's choose the tool again. From A to B, and then from B to C. And then you have to decide, is your exit going to be at one of these levels, or are you going to stay with the market as long as it is trending lower and until you can find an uptrend? There's also, let me find something for you. I just want to, where was it? I want to find you a chart with, okay, here we have a chart with moving averages. And this is an additional filter. Like I promised, I wanted to give you an additional filter. So the line charts and moving averages help you. As you can see here, the market has reversed quite recently, as basically highlighted by the 10-period moving average moving above the 50 period. And just to demonstrate, the different values don't make a huge difference here, whether it's 10 or 20. The main idea is that you want to look for these ideas, the bullish ABCs, when you have the 20-period moving average above the 50-period moving average. And then obviously your point D is going to be where you place your target level. And the same applies on the downside. When you have 20 period below the 50, your let's use this as a point A, then there's the point B, and here's a very, I think we would have chosen this as a point C when the market started to move lower. We couldn't know at the time that the market was going to retrace back to the level. But yeah, so this is a very handy, useful filter. You can choose different. Albert is asking whether the ABC strategy works better with Fibonacci retracements. You can use the Fibonacci retracements as a tool to define your levels between the point A and B. That is, let me go to the candles. I would like to actually suggest that instead of just using the retracements, you would use the price action itself. When you see the market starting to create lower highs, then you decide, yeah, that's my point C. But you can see if the retracement levels actually work for you. So based on my studies, there isn't actually one single level that works, but you could say that whenever the market moves between the 0.38 and 0.61, or say 38.2 and 61.8% levels, then look for your point C. That could be a guideline, but even then you are still subject to the fact that you have to look for the price action itself if the market starts to move lower. And so I think this is a point where I need to ask if you guys have any further questions, because I don't want to take too much of your time. We spent 50 minutes here already. I thought we could run this through in about 30 to 40 minutes, but let's take some questions if you have. And while you type in your questions, let me remind you or underline something highly important to you. These are guidelines only. This is not something that you should follow a letter to letter. These are concepts that work. These are probably the most useful tools for you in trading. There's a question about a preferable place of stop loss. That is a tricky one. There's there is no preferable point of a stop loss point. Let's say that there's many ways of approaching this, and as I said, risk management is something that we should spend time on, and really spend more time than this webinar allows us to. But first of all, you have to decide whether you're going to use variable trade sizes or whether you're going to accept variable risk. So let's use 𝗵𝗵𝗃 charts here. And I'm going to bring up the charts. Okay. And I want to use this for one specific reason. This is the preferable tool for executing the trades. This really is. But also there is this simple tool that if you choose the crosshairs and you keep your left mouse button down, it gives you the pips and it gives you the percentages. So if you want to know how big of a move was from this to this low, this tool tells you that it's 0.58% or about 186 pips. That's useful. So when you decide, let's imagine that we're looking to sell against this, and just to save time, I'm not going to draw ABCs here. I'm just saying that we are considering placing a trade here. The market is trending lower. The market is trading now close to the moving average, and we have a downtrend. So now if I want to have my stop far enough from the current price, I would need to know the recent range. That is about 0.62% or 73 pips. So this is a 4-hour chart, so this range is quite wide. But if I go the same distance above here, about how much was it? It's 63 basis points, 0.63%. So if I place my stop there at 1830, while I'm looking to trade around 1741, it's very likely that the market doesn't go there. It's possible, but it's unlikely. So that's the stop level, and the trade entry level is, say, somewhere here. That distance is roughly 83 pips. Now the options we have is to, obviously we could bring this stop lower. We could say that our stop level is here, but then we increase the probability of the market moving back to this area before moving down. These are just considerations that you have to take into account. So the two options here are that we either keep the risk tight, we either keep the risk always the same, we never risk more than 1% or 2%, and then we vary the position size in order to keep the risk equal. Or we say that, okay, we're always going to trade one contract, and then we sometimes have bigger losing trades and sometimes smaller losing trades. So that is something, when you get that concept, you can basically choose your stop levels in such a way that the market isn't very likely to go there. And obviously the smaller time frame charts, that the smaller the time frame, let's say I'm going to 15-minute time frame here, and if you're using something similar and say that this time we are looking to trade this break, the market tops there, and if it breaks this support, we're going to short. We go short. That's an idea. It's a valid idea for shorting the market. Then if you take the recent range here, that's about 20 pips instead of 60 or 70 pips. And you say that from this entry point, I'm going to have a 20 pip stop, which is roughly there. Then your stop size is smaller and you can have a bigger position in the market. And this obviously refers to a situation where you want to vary your bet sizes and keep your risk equal. Okay, I promise that we don't go into the risk management, but I think it's fair to touch the subject a little bit so that you know you have some tools, some takeaways from this webinar. All right, so any more questions? I think our people promised to give you a code that you can use when you go and deposit on your trading account. So I'm going to place it here in the chat. So there you go. I'm going to send it now. Okay, Carlo, you're most welcome. You really are. Any other questions? I think this was a very simple topic, but was it useful? Let me know what you think. Is this concept useful? I know from my experience that it is, but now the question is, was I able to explain it in such a way that you can actually find it useful and beneficial? Maybe if you are a really new trader, you would like to see something complicated. That's the way I was when I started. I needed to see something complicated to believe that it's sophisticated and then something that is really useful. But the simpler the concept is in trading, the better it is. Okay. Powerful information. 𝗿𝗲𝘃𝗀𝗀, thank you for your comment. And Carlo is saying useful. Kind of forgot Elliott when I moved to another strategy. It's good to combine if I combine it, I guess. I tell you something. Elliott wave analysis, in my opinion, is riddled with complexities. And those complexities allow too many different opinions on the same chart formation. So keep it simple, use A, B, C and D, and that's it. You know, there is this saying, KISS, keep it simple, stupid. I'd say ABC. That's one of the most powerful things there are in the markets. And you know why? We discussed this in the beginning. If the market is moving higher, it's creating higher lows. And if the market is creating higher lows, then we know that there is institutional money driving the market higher. If the market turns and starts to make lower highs, then you have institutional money driving the market down. So why would you fight against it? Why would you try to create something more complicated to explain it? Why don't you just trade the market as it is? I mean, that's the best. And when, you know, one more comment on this. Let me see if I can find you an example. There are times when the market just moves around in such a way that it's very difficult to understand what it's doing. Like here, for instance, bang, 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 bang. Moving averages all over the place, the chart itself all over the place. If you don't understand what the market is doing, just do nothing. Trade only when you believe you have an edge. Oh, thank you, Colin. Colin is saying a good presentation. Guys, I think we really have to call it a day. We have been here for an hour now. But before we go, let me have a quick rating of this webinar. Give me a rating on 1 to 5. 1 if it wasn't, if it was actually pretty bad. 3 if it was average. 5 if it was excellent, and something in between if you were happy. So I'd love to see your feedback on this. Kennedy, you're welcome. So just a quick rating so that I can compare this with the previous webinars and see if I can improve somewhere. So just a very simple number. Roland is giving me 5. Lovely, thank you, Roland. Anybody else listening? Can we get a number? Colin, thank you, Colin. 4.8. That's a very high number. I'm honored. Thank you. Sam is giving you 4.5. Carlo 4.5 as well. Kennedy 4.7. Hey guys, I really appreciate this. Thank you. It's been great to spend this hour with you. And if you have questions, go and email support@𝗿𝗏markets.com, and you can ask them to forward the email to me, and I try to answer you in the next webinar. Cool. So I hope that you trade safe. Never trade without stops. Never trade with too big of a position size. You have to decide what's good for you, and based on your previous data, previous trades, you can decide what level of risk you should be taking. Just keep the risk constant and make sure you are in the game tomorrow as well. Lovely. Thank you guys. Thank you for your time. Take care and see you soon.